Okay, let's tell you what you will get to see on the show. I gave you a trailer actually. It's a power-packed lineup on Trading Hour today. Motilal, Oswal, Financial Services. Joint MD Raamdeo Agrawal, as you can see, is being ushered in by Varinder Bansal, our head of research. He will be taking his place with the anchor's seat today. He's a guest editor, so he will be asking editorial questions to a host of guests whom we have lined up at Raamdeo's request, some of them. Raamdeo wanted to discuss the IT sector as a relative safe harbor, as well export-oriented sectors with this defensive backdrop. So Krishnamachari Natarajan the CEO and Managing Director of Mindtree will join us broadly to discuss that IT space which Raamdeo thinks is a safe harbor. HDFC is again one of Motilal Oswal's top bets in the financial space. KK Mistry, the big man, Vice Chairman and CEO of HDFC, will be joining us to discuss the company's growth as well as the sector, of course. We'll discuss the theme of small caps, big idea as well with Mr. MP Taparia, the Managing Director of Supreme Industries, one of the supreme outperformers in the Motilal Oswal portfolio as well. It's in Motilal Oswal Focus 35 portfolio. For the moment, Nifty and Sensex down 1%. 7377 on the Nifty is pretty much the lowest point of the day. We went maybe 15 points lower, 7362, but give or take a few, we are still at the lowest levels. And the Bank Nifty, which showed signs of some short covering, is once again down 1.3%. Advanced declines, 9 down for 1 up. So 90% of the market is in the red. That's the time you want veteran advice. That's the time you want someone who can keep his head and help you keep yours. Raamdeo Agrawal, Joint Managing Director, Motilal Oswal Financial Services, is with us, joining us as our guest editor today. Morning, Raamdeo.
Good morning, very good morning.
Thank you very much for joining us. You know, whenever we met you in the last 2 years, you've been saying, don't do an SIP, put your money now.
Yes.
What will you tell people now? Some of them would have lost.
Yeah, so money is already in. So you got to be sitting tight now. You know, whatever you have bought, because see, the short-term understanding of the market, how what it will do, because more and more shorter end of the market is very irrational. I mean, we would not know how the markets will close by 3:30 today. I mean, will it be down another % or will it be recovering all the way up? So nobody knows what is going to be the end result. So its predictability is very poor right now, and there is a lot of volatility in all kinds of markets all over the world. So it has its own connections here. So it is very difficult to rationalize what is irrational. So I would, I don't have any theories to. I think basically the chartist guys, they are the best guys. They can see in their charts what is going to happen in next few days or whatever. So probably it is a paradise for the chartists right now.
Raamdeo, hi, morning. No, I take your point, but you've always maintained that as an investor we should be worried about what is the downside to this market, and once that downside is over, the upside will take care of your portfolio. This year has been ranked bad for portfolio investors. Some of the best performing mutual funds, for example, the NAVs are down quite a bit. According to you, not for today, what is the downside right now in this market? Could we go to sub 7,000, maybe even 6,500 on the Nifty?
Yeah, quite possible. I mean, the kind of momentum which is there, losing another 5% here and there, I mean, for a few weeks and all, is not completely very low probability event. It could be a high probability event. So probabilistically, short term, anything is possible, 5-10% decline. But I would be very surprised on a 12-month basis. See, because I'm talking about investing. In trading, I have no clue what is going to happen. But if you invest for a year or 2 or 3, I would be very surprised market after 12 months would be significantly away from 73, 7400 current levels. I would think it will be somewhat higher. Okay. Depending on what all happens, but I would definitely bet that it will be higher from the current levels.
And what would be the trigger for that?
Yeah, so trigger is that first thing is this decline of oil, which started say almost 2 years back, 1.5 years back. That has moved from 110 to say 25 or whatever, and now there are tens of reports saying that it will go to $17 or $15 or $10. I mean, Saudi Arabia is not going to finish off itself. It's not going to commit suicide in terms of oil price. So obviously there is some sanity. They came in Davos and they said $30 is too undershot kind of thing. So I think sense of stability should be coming at about whatever the price, 30 to 40 or 30 to 50, what should be the range. But I think as the one large market stabilizes, the oil market, which has taken steam out of a lot of economies, lot of companies. We saw the Exxon, Mobil, BP,
losses
80-90% correction in the profit. So I think these things are very, very destabilizing. I mean, these stocks are listed in, say, US. So US indices will also go down, you know. So clearly, the first thing is that oil must stabilize, and we are seeing some sense of stability coming in. Not fully stabilized, but looks like the bottom it has hit. So once oil stabilizes, then other commodities also will get some kind of a stability. So everything has hit the bottom, whether it is coal, gas, iron ore, zinc, aluminium, everything is in pits right now. So this entire commodity pack, if it stabilizes even in the next 6 months, then the second half would be new norm and new normal for the entire world. People will learn to live, what to buy, and maybe consumers will come out. So a lot of things will change. I cannot foresee everything, but I know when things are bad, it is very difficult to figure out what will. So at the bottom you cannot see the top. At the top you cannot see the bottom. You know. So right now we're at the bottom, somewhere close. That's what I believe. So it is. I mean, I remember in 2002-03, I used to think that in new high-low there used to be 1 or 2 stocks. Not even 5-10 stocks. I used to think, when will I get my 20 stocks in new high? You know, and it used to be a wish. By 2007-08, half the market used to be new high. So when you are in 2002-03 bottom, and this is the kind of time we remember these dates, you know, you can't see much highs. When you see today, I don't think there will be too many highs. And all-time highs would be literally nothing. This will be all 52 weeks manipulated highs and
except Infosys maybe.
All-time high?
Closer to that.
Is it? That's quite an event if it is all-time high.
Yeah.
But so very few all-time high would be there. And when the markets are at the top, you see hundreds and thousands of shares hitting new high almost every day. So these are the depressed times, and one can keep justifying, can it go another 5% down? Yes, but these are times to really prove yourself whether you're a trader or investor. Only the true investor would stay invested right now.
Okay. You know, what would be the new themes in the market for your preparing for a period of probably global recession, or at least stagnation, if not recession, and you're preparing for an Indian economy which is going to see no producer price advantage at all. Pricing power is zilch. Going to see probably a
Why
little bit
pricing
of
power is zilch?
in many of the sectors. The ability to price, unless you're a brand, unless you're an iPhone, you're not able to price your way. So in such a situation, what are the sectors that you would choose, or even one sector as a safe harbor?
No, so you know, it's all about the companies. I obviously look at businesses also, but it's all about the companies. What I have seen in my wealth creation studies, more recently in this one, 20th wealth creation study, mid to mega, that the growth can be anywhere. In worst of the time, you can find 20-30 companies growing very rapidly. And you've seen that discussion, you know, like today, say, Supreme Industry has grown at 40%. You know, so and you see like Pidilite turned out to be a fantastic result. Webco has given very good result. So there are bright spots. It is difficult to find them. I mean, it's not that 500 out of 1,000 companies are growing at that pace. It will be probably 100-150 companies out of 1,000 companies. So percentages of companies doing very well are fewer for sure. So the amount of money you'll make at this point of time will be less. This is a time to save the capital, protect the capital, and make, if you can make some money, that's good. But this is a time to protect the capital.
Okay. Raamdeo, are you rattled by what's happened with Interglobe? I remember we talked about it a month back. That's one of your largest holdings in your fund also now. And the follow-up question would be, is this time to accumulate more? You know, the market is a bit worried about maybe the disclosure quality or whatever, but the stock has fallen 40% now.
I mean, I'm surprised by the pace of fall. I mean, I was pleasantly surprised by the pace of rise also.
Yes,
that it gets listed at 850 and it's a kind of dream run, goes crosses 1300, and then with one spooky result, the whole thing collapses. So multiple things happened. Of course, the disclosure quality, expectation management by the company is a lot, you know, to be desired. But I don't think they have earned anywhere on a kind of a legal basis or anything like that. But I think they could have managed the expectations much better. One is that. Second is that I think this new schedule and all. I mean, see, it's a high. In aviation sector, it is a ultimate growth stock. Now, the source of growth driver is the delivery of the planes. Now, there is no insight, there is no probability of that coming through. Is literally, market is believing that it's zero, that anything is going to come. Visibility is not there, it's very hazy. At least I don't know when it is going to come, and there is a history now. We realize that history of any new models is quite checkered, whether it is a Dreamliner or a whole lot of, I mean, it's a very common phenomenon that whenever new models are being introduced, they have teething problems and it takes some time to stabilize, whether it is 6 months, 1 year, but every quarter or every year is going to cause this company, it's a growth momentum. So it was priced to perfection for the growth. Clearly now growth being delayed. Obviously you have to pace. First thing is the current year's earnings itself.
So you enter only when you see the visibility of the new planes flying in, or add only at that time?
No, it's a great stock. I mean, it got issued at 765. So and now it is more like 850 and 850 and all. One can accumulate. I mean, it's a but it will fly only when growth visibility is clearer.
Okay, Raamdeo, we have to take a break, but we have plenty such questions for you.
Yeah.
We are coming back with our budget guest editor Raamdeo Agrawal in a minute.
Welcome back. Well, the market at this point in time is closer to the low point of the day than to the high point of the day, but it's been that kind of a day, especially for the mid-cap market. The mid-cap index, that is, down about 1.6%. Advanced decline ratio today has been terrible, 1:10, so it's been a rank bad day for stocks with the market breadth so poor right now. We've been in conversation with Raamdeo Agrawal, joint MD at Motilal Oswal Financial Services, who's our guest editor today. Raamdeo, you've been bullish on consumption stories, especially ones with pricing power. Eicher Motors was a great example. What about something like a Maruti, which again is one of your top picks? But do you get a sense that somewhere they might have lost a bit of pricing power or some of the sheen, and that's why the stock has also corrected 20%?
See, unlike motorcycle or some other segment, here, though his market share is upwards of 45%, for the rest of the 55%, there is a whole lot of the world is trying to snatch each other. Toyotas and Hondas and General Motors and Ford and you name it, everybody is trying to get because there is a large market. You know how much China is selling? They are selling almost 2 million cars a month. We sell hardly 2-3 million cars a year. So in next 10 years, if India goes China way, that's a possibility. So everybody is trying their best effort here. They are bringing best of the products. So much so they are buying companies or designing products only to win Indian markets. So I think it is going to be intensely fought battle, and it is not going to be that easy to protect the margin or even the market share. So it's going to be very well fought profit for Maruti. I think one of the things which we heard our analysts and all are saying is that for next 12 to 18 months, will there be enough production capacity with the company to meet the eventual demand if it turns up more like if it is more than 10%, 12% demand? Is there enough? So that hurts the margin is more or less done. So the only source of growth is going to be from volume. But if you don't have production capacity, so you are next 12-18 months kind of till the new plant comes in, that's a concern analysts have, and hence. But
you don't share that concern.
No, that concern is there, but it's not for 10-year issue. It's not a 3-year issue. It's a 1-year issue. These things happen, and companies saying will supply. My sense is that there is a demand. They'll produce at mid of the night and they'll supply, but that's leap of faith.
Okay.
So that's what happens at times. You think one way, and so that's how his stock has corrected also. So in bad times, if people believe all the negative arguments, nobody will believe in the positive arguments.
Okay. Your favorite financials have been just the two retail-facing banks.
Yes.
HDFC Bank and IndusInd Bank.
Yes.
But now you're getting some of the economy-facing banks at fairly decent bargains. I'm not referring to PSUs just yet. I'm referring to Axis and ICICI. You will not think that these are attractive. I mean, they've proven managements, but they're going to a rough patch.
Yes.
This is not a time to dip in.
So yes, yes and no, because you got to be comfortable with the book. Right now, wherever underlying book has corporate loans or infrastructure loans, so how much is the bad loans and how they are going to push it through the system? Because for public sector banks, in any case, there is no equity value left in public sector banks. It's all option value, whatever little is there, 3,000 crores, 5,000 crores, they're all option value. This is not equity valuation of PSU banks. But private sector banks, government is not going to come and give you capital free of cost, and their valuations are not like an option value. They are serious equity valuation. So the book has the common companies which are source of stress. So once these things are clear, obviously these companies, these banks are very well managed, and they would be great investments.
So you're not a buyer just yet over there.
Yeah, I mean, till this dust settles, I mean, I don't want to get into where underwriting messes there anywhere. Okay. So if we have ordered so far, we would stay out.
Okay, I guess we can just cut across to the finance minister. He's speaking at the Invest Karnataka Summit. So just listen in to see whether we're getting any hints about the budget.
Under these circumstances, when comparable economies are struggling, we have an important and a powerful opportunity ahead of us in order to make sure that our own domestic economic systems are strengthened. And in this strengthening, we have been able to maintain a macroeconomic data and situation which is far more favorable than what it has been in the past. And that's what makes us as India the fastest growing economy in the world. But that does not mean that we don't have our own shares of sleepless nights.
Okay, the world is in a bad spot, but Raamdeo, in spite of it, you have some export themes, largely IT.
Yes.
You would continue to
IT,
bet on
pharma
IT?
is also there.
IT and pharma. Okay,
Yeah.
let me start with IT.
Yeah.
You would still keep your bets. After all, they've become commoditized. I mean, the day of great earnings is gone, you would think?
No, I think still in terms of size of the earnings, I think what you have earned in the last 15-20 years, they will earn multiples of that in next 5 years in terms of absolute numbers.
Okay.
So I mean the larger companies which are there, their growth, because of the base effect, growth will be much more muted. But what guidance I am hearing from now larger companies, everybody has a 2020 targets. Infosys is saying 20 billion, Wipro is saying 15 billion. TCS is yet not been that explicit about their growth targets, but Chandra would not be behind in terms of at least having internal targets of numbers. So these are very impressive numbers, and the currency devaluation, see, they have a cost, volume, price mix and currency.
Currency advantage.
Okay, so currency advantage, this almost 10% devaluation. The last round of devaluation somehow has not panned out in terms of margin expansion. I think all those companies, they used it for becoming much more aggressive in terms of taking the clients and maintaining the EBITDA margin around 25-27%. My sense is this round again, if they maintain the margin and profitability returns are very good. What you need is now actually top line growth. So if they blow this money, extra margin for top line growth, so if in current situation getting 10-12% dollar growth is fabulous, and helped by a bit of currency devaluation, you're talking about at least 14-15% kind of top line.
Okay, so one of the top picks of Motilal Oswal is actually Mindtree, and we have Krishna Kumar Natarajan, CEO and MD of Mindtree, now joining us. Krishna Kumar, hi, good morning. Good to have you on the show. We have our guest editor Raamdeo Agrawal also sitting with us. We were discussing top line growth, dollar revenue growth for IT companies, and the kind of visibility.
Morning, Anuj.
Good morning. We were just discussing the kind of visibility we have on the top line growth in terms of dollar revenue growth. If you could tell us the kind of visibility you have for, say, next 4 or 5 years.
Anuj, I'll really just bring in some industry perspective and also talk about Mindtree. Like Mr. Agrawal rightly said, I think technology is becoming not just an enabler, but becoming a competitive advantage for enterprises. So the NASSCOM 2025 perspective report, of which I was a part of, indicates that the industry can almost grow threefold to about 400 billion by 2025. So there's a tremendous opportunity for companies, and driving this change is the focus towards digital transformation, which is where Mindtree is really focused on. So if I now zoom into Mindtree, I do believe that over the next 5 years, we have a great opportunity to consistently deliver at least a double-digit dollar growth consistently year after year.
Okay. Your digital space itself, I think, is now contributing about 36% of your new orders. What is the visibility on that, say, in the next 2 years? Does it get well over 50%?
Lata, you're right. I think if you look at the growth rates which you've had in digital, it has consistently outgrown the company average growth. FY15, the company grew about 15%. Digital had a growth of almost 26% year on year. And for FY16 also, the trend is pretty much the growth in digital is far ahead of the company growth average. So we do anticipate in the next 2 to 3 years, digital would be probably 50% of Mindtree's revenues.
Raamdeo, you have questions for Mr. Natarajan?
Good morning, sir. The margin at your level.
Morning, Mr. Agrawal.
Yeah, very good morning. The margin scenario is
Yes.
kind of not very good. I mean, the big ones have upwards of 25%. Your company is very well respected, extremely well respected, and one of the contenders for big spot if ever another company makes it to the big league. So in that situation, do you think when you grow, the margin will also grow, or it will be at the cost of the margin?
Mr. Agrawal, you're right. What we had consistently done in the last year and a half was to invest to get a higher dollar growth. And particularly in areas like digital, we made significant investment, and that has certainly come at the cost of margin. But what we do believe is the scale plays in here. The difference in margins between the larger players and Mindtree would primarily be the difference of scale, which is at the SG&A level. While we are at an SG&A level of about 20-21%, the larger companies are at 14-15%, and as we scale up, the margin gap will sort of narrow down. But I would not anticipate that we would be at the 25% margin levels, 24-25%, which the larger players are at.
Okay, but I guess Raamdev's question, Mr. Natarajan, is whether you will sacrifice margins for more growth, or whether margins will be sacrosanct.
Lata, you're right. In the last 2 years, I think we have consciously invested and sacrificed margin in the context of growth, which is why both FY15 and in FY16, we are confident in FY15 we were, and FY16 we are confident will be significantly ahead of the industry growth rates. Going ahead, I think we'll really watch the way in which the digital market really expands. If there is going to be, I would say, a rush to gain market share, I think we would certainly love to or like to do that. We have already leaderships in specific areas within the digital space. There we would certainly consolidate and try and use that levers to improve our margin profile also.
Okay, just to carry that point forward, you made 3 or 4 acquisitions in the past all related to digital and with quite a bit of investments. Are you done with that spree, or could we see some more acquisitions over the say next 1 year or 2 years?
Anuj, you're right. I think we've been sort of in the context of expanding market where need to build capabilities and customers is critical. We have done 4 acquisitions which are in the digital space. Clearly the focus in the next 12 months is to assimilate this and ensure they drive both synergy as well as establish our leadership in the digital space. So going ahead FY16, we would only look at critical assets. There are some gaps still, but clearly it will not be at the pace at which you have done in FY16. FY17, certainly the pace of acquisitions would be much slower. The focus would be on assimilating these and ensuring they drive our leadership agenda.
Raamdeo?
Yeah. Sir, you mentioned about 2025 NASSCOM estimate of about 400 billion, which incidentally is little bigger than what Saudi Arabia's oil export was when oil was at $100. So their export was more like 325 billion, and we are anticipating $400 billion of IT exports, which is better than oil because it is well spread out. So if that were to happen, I mean, you can imagine what will it do to the thing. But from the current levels of about 100 billion, 100 or 110 billion kind of current situation, we are talking about upwards of 13-14% compounded dollar growth. So which is very exciting number for 10 years. And we have consolidated players amongst us. So should one, as an investor, should one put bet on larger companies, or should one look at mid-sized companies who have the better right to win in the future?
Mr. Agrawal, I am a little biased player here, but what we do believe at Mindtree is that there is a space for what we call multi-segment specialists, people who focus on a few segments and have both the capability and the confidence to compete with the larger players and win business against them. So that's one number at Mindtree we keep measuring all the time. The number of deals which we win against the larger player and how that ratio is moving. So I would certainly think the market is large. The good part is it is growing and we anticipate that it will grow over the next 5 to 10 years. It will continue to grow. So there is a great opportunity for focused players who can build world-class capabilities and have the confidence to compete with the larger scale players.
Okay, that it was an encouraging conversation. Thank you very much, Krishna Kumar Natarajan, for joining us with your thoughts on the IT space and on Mindtree itself.
Thanks for him to come up.
To have joined us, yes. We have to take a break on that note, but we are next going to be joined by another of the management of another of Raamdeo's favorite stocks. We will be joined by KK Mistry, Vice Chairman, CEO, HDFC, when we come back. Welcome back. Well, just one look at the markets at this point in time. They continue to linger at the same place actually. 73.70, 75, 73.80 is where the Nifty has been, and it's a deeper cut in the mid-cap space, 1.5%, 1.6 lower, and the advanced declines, which was 9:1 when we started, it's 9.5 to 1. So there's just that much more weakness that the market has seen, but weakness as well in the banking space. That bank Nifty is down 1.2%. Well, HDFC is not a very big culprit, though that stock has not been the dramatic outperformer it used to be. We're being now joined by KK Mistry, Vice Chairman and CEO of HDFC. Mr. Mistry, thank you very much for joining us. Business is tough for everyone, but has it gotten just tougher even for the high and mighty like HDFC? Your retail portfolio is a very crowded place. There are so many players down the chain, and your corporate portfolio, well, it is subdued because real estate is not doing well. Is business getting tougher?
See, as you mentioned, Lata, we have two parts to our lending. One is the retail part and the other is the non-retail part. Now, in the retail bit, though you mentioned that the place is getting crowded, we have actually not seen any slowdown at all. If you look at the growth numbers and if you add back the loans that we sell, we do not retain all the loans that we originate, we also sell down loans. So if you look at a gross figure before selling loans, then the growth in the retail book, even on this very large base, continues to be in the 20s. We had a 23% growth if you add back loans sold in the last 12 months. It's in the non-individual portfolio where there is a reduction in growth. If you take the last 12 months up to December, the growth has been 10%. But one of the reasons why the growth, I would say two reasons. Two reasons for the slower growth. One is our own risk averseness. So if you look at the developer book, we artificially restrict the quantum of lending that we do for construction loans to not more than a certain percentage of the balance sheet. So unless and until the other parts of the non-individual business, which is lease rental discounting and corporate loans grow, there is a limited growth as far as the construction loans are concerned. Having said that, in the third quarter of the financial year, particularly towards the second half of December, we did see a spurt in growth, and if memory serves me right, we had about a 30 billion rupee growth in lending in that last fortnight of December.
Okay, Mr. Raamdeo Agrawal is with us, like I told you, Mr. Mistry. Go ahead, Raamdeo.
Good morning, sir.
Hi, Raamdeo. Morning, Raamdeo. How are you?
Yeah, very good. One of the things is that after 2-3 years of very scorching growth, even as a consolidated, because your associated companies' profits, insurance, mutual funds, banks, all put together along with your mortgage was pretty good. Upwards of 20% and all. But even that consolidated portion, apart from what you said about the retail and wholesale loan, do you see this being a very temporary phenomenon, and say starting from 16-17, we could again go back to 20% kind of consolidated growth?
See, if you look at our profit growth and why the profit growth has been relatively muted in the last, in this financial year, has largely been because of interest rates. So if you look at our balance sheet now, out of a 2.5 trillion rupee balance sheet, 2.5 lakh crore balance sheet, about 35,000 crores is shareholders' funds. Now we keep a very matched balance sheet. We don't take mismatches. So on the 2,15,000 crores of borrowings that we carry, the spread has been maintained. We had a spread of 2.31%, if I recall right, in December, and 2.32% in September. So broadly, it's in the same band of as far as spreads were concerned. But on shareholders' funds, so when interest rates came down in the economy, the cost of funding came down, our lending rates came down, the spreads were maintained. But on shareholders' funds, which is as much as 37,000 crores of our balance sheet, there is no cost, because obviously shareholders' funds, there is no interest cost, there is a dividend payment. Now when interest rates come down, there is no reduction in cost. But the revenue, the income that we earn on deployment of the shareholders' funds, that income is dependent on interest rates in the economy. So if interest rates come down, the quantum of income that we earn on the shareholders' funds will also come down. So on 37,000 crores, you take a reduction of about 100 basis points during the quarter. It explains close to a 100 crore reduction in profits in a quarter. Now that base effect at some point of time will get sort of settled. So if we were to look at the quarter ended September of 2016, that base effect will get fully sort of priced in. So my sense is growth should hopefully come back in the numbers. As far as the consolidated numbers are concerned, the insurance company has been doing well. In the insurance company, what happens is when the growth is strong, the profits are lower. It's a very ironical thing. When growth is higher, you pay higher commissions, and the higher commissions are charged to the P&L account upfront, which results in lower accounting profits.
Okay, Mr. Mistry, therefore, what's your sense about this 20% run rate? You can maintain it for how many years, you think?
On the individual loan book growth, I mean, we've never talked of 20%. Historically, we've been growing at 20%, but we've always told the investors that by adding back loans sold in the previous year, we would expect a growth of 15 to 18% with a long-term view. And when I say long-term, I mean upwards of 5 years. I would still hold that view. It's not that it has to happen every quarter. There may be a quarter where it's a little lesser, there may be a quarter where it's higher, but we would expect a 15 to 18% growth in the individual loan book after adding back loans sold for a fairly long time. And that is because of the way the Indian economy is, the way the dynamics are, the way the population is centered. If you look at the population today, 60% of India's population is below 30 years of age. And the average age of a customer when he or she first takes a loan from HDFC is between 35 and 38 years of age. So it's not a 25-year-old person who takes a loan, it's a person who's in his mid-30s. And with 60% of the population being below 30 years of age, all these people will progressively over the next 1, 3, 5, 7, 10, 15 years need housing and therefore housing loans. So on the individual retail part, I have no doubt that the growth will remain strong for a number of years because of the sheer demographics, because of the low penetration levels. Mortgages today are only 9% of India's GDP. Housing has become very affordable. When I say housing, I don't mean property in central Mumbai or South Mumbai. If you look at the average loan amount this year, it's about 25 lakhs. Our average loan to value ratio at origination is about 65%. So we are looking at a property value which is typically in the 35 to 40 lakh rupee range. Even in Mumbai, our average loan amount is only 40 lakhs of rupees. So you can see the kind of loans that we give. They're all in the distant outskirts of the city.
All right, Mr. Mistry, thanks a lot for your time today and talking to us.
My pleasure. Thank you.
So that's HDFC. We have one more company joining us, and that's Supreme Industries. And if you look at the stock of Supreme Industries, as Raamdeo pointed out, there are still some stocks which are closer to, very few stocks closer to highs, and Supreme Industries is one of them. MP Taparia, MD of Supreme Industries, is with us. Before we go to him, Raamdeo, a word on this stock and why do you like it?
Yeah, so this is one of the best run plastic processor, I mean, in my view, and if you see the return ratios for last 10-15 years, they were upwards of 20-25%. They have maintained steady growth except for last 3-4 years, maybe because of the high plastic prices or whatever. The growth has been a little slowed down. But if you look at the terms of trade, I mean, usually in this trade, because there are a lot of competition, typically people are not able to recover their money even for 60 days or 90 days. Here, these people, they recover money in 15-20 days, literally sell the stuff on cash. So the cash flow is very good, dividend payouts are very good, and they have been growing at a 15-20% for a long time, except for last 1 or 2 years. So that's the kind of a profile they have.
Okay. Well, actually, why don't you go ahead and ask Mr. Taparia your question first?
Sure.
Okay, I should be telling you that we are being joined by Mr. Taparia, the Managing Director of Supreme Industries.
Yeah.
Over to you, Raamdeo.
Yeah. Good morning, sir.
Good morning, sir.
Yeah. So, one of the thing was that you are one of the biggest beneficiary of crude collapse, which is historical in nature in last 15 months. How do you see the impact of this in your business in terms of, clearly in terms of volume expansion? It was much more muted in last 2-3 years, but do you see it catching up and going at a distinctly higher rate in next 2-3 years?
Before I talk about my company, I can take the data of our country. In the first 9 months, that is April to December, the country has shown a volume growth of plastic consumption in excess of 14%, which is 1.95 times of GDP. We have never seen such a growth in volume in relation to GDP in last 7 years.
Okay.
So definitely crude price collapse has helped our country in a big way. It has reduced our working capital requirement. It has improved our operating margin. We could utilize our capacity better. So the crude price collapse is definitely quite good for our company. Except that we had some inventory loss. When the prices were falling, we have to suffer inventory loss. But in spite of inventory loss, it was better for the company.
Okay.
Sir, you have two segments. One is the value-added segment and other is the commodity segment. So, how do you see the mix changing towards, one is the volume itself. Are you going to see volumes recovering to, say, industry itself is 14-15%, but I think these quarterly numbers are not anywhere close to 15% for you. So, is it going to go back to 15+%, you being the leader? That's one thing. Second is that, is there a change in the mix between the value-added and commodity plastics?
by a conscious decision, we want to go on reducing our share of commodity business. It started at 31%. Last year it was 34.2%. This year we believe that we will be crossing 35% plus value added. When our turnover goes up, so value added, though absolute quantum goes up, but percentage wise it cannot go very high. In the second quarter, that is October-December quarter, we always have off-season big sale of our cross-laminated film product. We give a very high percentage of value-added item. As you have seen, it was 42%. But normally, it remains good. We are moving now to go on increasing our share of value-added item. And this year, as we expect that though this year is for 9 months, we should cross 35%.
Okay. I think you have a 4.2 lakh ton capacity. How much do you see it expanding in the next 2 years?
Yeah.
I can tell you this year our capacity beginning was 450,000 ton, and this year in the first 9 months, this is year of 9 months only, we'll expand it to 500,000 ton. Over a period we'll go on expanding. It may go to 650,000 ton in next 3-4 years.
Okay. Well, Mr. Taparia, we could have gone on, but we are out of time on the show. Thank you very much for joining us and giving us that perspective that actually plastic consumption for the country itself is growing at twice the rate that GDP is growing.
Yeah.
So you can, estimate what a good producer, what a strong margin producer can make in a time like this.
Yeah, okay. Before we take a break, Raamdeo, final words to you.
Yeah.
And let's discuss the market again.
Yeah.
We are now 15 or 16 days away from budget.
Yeah.
So the standard question,
Yes.
can the budget deliver for market, and what would be the top expectation from the budget?
So it's, we have seen 2-3 disappointments in the past in terms of budgetary, announcements and all. So I actually don't expect anything from the budget personally, but it is going to be a big, if you see the last speech of in the summit recently, it is looking as if something dramatic is being done in this budget. But what comes out, what is in the wraps, taxation is. I've heard that direct taxation is being discussed, subsidy and incentive, and so a lot of discussion is there in terms of bringing down the tax rate. When you bring down the tax rate, you are obviously going to take away wherever the exemptions are there, or wherever free rights are there for the SSEs. So what exactly will be the extent of change? Will it be truly transformational? They'll come down from 30% to 25% and take away everything, and it becomes very simple for, and what will be the impact on the capital markets in terms of capital gains taxes? So those are things to watch, but apart from that, it's a business as usual.
So instead of sitting with your analysts and watching the show, this time you will watch the budget with your tax consultant?
No, it's fun to watch the finance ministers, give all those.
But you're not going long on any set of stocks before the budget?
No, I don't. Budget or no budget, investing goes on in the sense that they cannot make or break any businesses. If oil has fallen from 100 to 35, or power companies are doing well, I don't think budget will make that much difference.
Fair point, Raamdeo Agrawal. As always, it's a pleasure listening to you. It's an enriching experience. Thank you very much for joining us.
Thank you.
And we will touch base with you, of course, on budget day and thereafter.
Sure, thanks.
Well, Anuj, last thoughts on the market. Holding on 7385, perhaps till London opens?